here so we can make sure we have enough time for questions and all that good stuff towards the end. Wilson, thank you very much. I appreciate you guys and gals joining me here on a Monday, a rainy Monday here in Michigan. I guess it's that time of year, I guess. It's going to be snowing here pretty soon. Don't like to say that, but it's going to happen. But thanks for coming. In this presentation here, I'm just going to go over some multifamily investing information. Just kind of, show you what's going on and kind of give you an idea of what the next steps will be from this presentation going forward. Let me make sure I can click through here. Here's kind of our agenda here, who we are, who I am, what we do, and I got to still make sure that I have somebody emitting people there. All righty. So this is our agenda, and how the third bullet point there is how apartments investing compares to single family investing, why investing in apartment buildings works, what are emerging markets, and we'll kind of go over that. Next steps, and then obviously the questions and answers. We're going to leave a lot of time in there for that, because I want to be able to answer all your questions. Who are we, or who am I? We're an investment and management company that acquires and manages multifamily properties in emerging markets, and that's kind of the key there. We use a lot of demographics to target cities and states that are emerging, meaning, and I'll explain that a little bit further here in the presentation, that are up and coming, that have job growth, that have some signs of, let's say, life, unlike, let's say, a Flint, Michigan, where it's pretty much dead. No offense to people who are in Flint, but obviously we improve the cash flow and move on from there and turn around and sell. And typically we've been doing 5 years. Now we're looking at 6 to 7 year holds because of the COVID effect. And we also offer opportunities of other top syndicators, and I'm not a top syndicator, but to our group as well. And that's one we do have, one we're looking at right now that I'm raising money for from another syndicator in another state, which I'll kind of go over a little bit towards the end here. So we also offer that. So I'm kind of networking and in tune to a lot of different things in the real estate realm, and networking with a lot of different people out there, a lot of different opportunities that may be beyond the borders here of Michigan. That's where I'm based. And a lot of different states are doing better or doing worse than Michigan. So what do? We have 5 main functions, right? We locate the emerging markets in the U.S., but again, by performing market research, we look at job growth reports, population growth, path of progress reports, and local economic reports. I go down right to the neighborhoods, so I can see block by block in a census block what is a good area. The reason I do this type of information and do this type of due diligence is, when we're buying a property, we want to make sure that we can execute our business plan, right? We can raise the rents, or, well, if 85% of the population is below the poverty level, you're probably going to have a hard time moving the rents up. You're probably going to have to move the rents down. And with investor money, with people such as you, that's not a good thing, right? You need to invest in something that's going to be going up, and we can make money at it and refinance it and get money back, and or when we sell, there's also profit in there as well. We locate value add multifamily. Obviously, that's a kind of a catchword, and I'll explain what value add is. The emerging markets, we deal with brokers, we deal with pocket listings, or let's say, off-market deals. We also do direct-to-seller mails. We also have called. We've also texted. Did a lot of different direct marketing to sellers, as well as using the broker community, who really are the gatekeepers of this business, and a couple different services that we get: foreclosures and short sales. Not too many in the short sales in the multifamily. Foreclosures, and we're not seeing a whole lot of those yet, and I don't know if there will be, because of the fact that the banks have been doing the forbearances and are very aggressive compared to 2008 as far as helping out the landlords. And there's a lot of state and federal money for that as well. We do the property inspections. So basically we're full service. So if when you invest with us or on a property with us, there's nothing for you to do other than just look at your statements, attend the webinars, open up the emails we send you, stuff like that. So we're not expecting you to invest money and then, hey, by the way, get on a plane and go and inspect the property if it is out of Michigan, or even drive to it. You can drive to it, that's no problem, but we're not expecting anything from you as the investor. Okay, we also negotiate contracts and place on financing on the property. We take care of all that. You're not involved in that. We know what the financing is going to be on the property typically before we put a PSA or a purchase agreement on it. So that affects our returns. And there, sometimes that at the last minute could change. But in today's market, it's we have enough leeway in there to do that. So again, we don't look for you as the investors or investing in this. And this is, if you don't want to invest in with us, although other syndicators as well, ask them questions like, are you expecting us to do anything? They shouldn't. Okay, and then we also do the asset management part of it, and that's the biggest part that we feel, and that's where we execute on our business plan. That's where we get in there and raise the rents and do the manage the manager. We use third-party property managers that we vetted and meet our criteria. So we go in there and review their reports, and then those reports are combined and compiled and then given and shown to you during our monthly meetings as well. So that's the biggest part of this job, is being a let's say investor relations, or investor in property management, or in multifamily, is the asset management part of it. The buying it and the due diligence, that's that is challenging at times and stuff, but really where the money is made is in the asset management side of it. Are they executing on the business plan? And if we didn't, why? What are the steps that we're going to take to meet the goals if we didn't achieve them this month, to next month, stuff like that. And again, we do visit the properties on a pretty frequent basis for that. So but we do all that. That is not anything for you to do. Now, obviously, you can visit the properties that you invest in. Fantastic. You can do that. We encourage it, but we don't require it. And then 5, when we get down to rolling up the business plan and executing the business plan, the liquidation of the property, that's usually the last phase. And then we take care of all that. We engage a broker and we get it under contract for sale for a strike price that we already know. Typically, the strike prices we know usually right around the date of purchase of where we want to hit it for, because that does again affects all of our returns going back. So if we say we want to sell for X and at this cap rate, and that's what we project and do all our projections on, and the projections that we give you and the opportunity packages and stuff that you'll be receiving with that. So that's usually a pretty good 5-step process that we follow to do that. Obviously, I'm doing a high-level overview here. There is more detail that we can go into, and then that's the next step or next phase in this. This call tonight is just kind of getting you familiar with it, getting familiar with me again. And I've seen some of you on the call that I've already talked with and stuff like that. But again, with the SEC rules, I've kind of got to do it in a 1 and 2 and 3-step process here. So that's why we're doing this tonight. Let's compare single family homes versus apartments, right? You got on the left-hand side, your left, you got a whole bunch of homes all over the city, which I can totally relate to, versus one building, one block of the neighborhood, you go to one place, right? Obviously, there's a lot bigger differences in that, and I'll get to those in a few seconds here. But in the first swipe, that's typically the thing. You got 3 different roofs, you have one roof, right? So it kind of it makes it out. Many of us are single family homes, which I have come from too as well. Tenants, toilets, and trash, right? You got landlord burnout. You got headaches, low cash flow. single family, depending if you're Section 8 or if you're doing regular leases, expensive management fees, because again, you can't really scale with, 10, 15, 20, or even 50, because they're all over, unless you own the whole block. The property management are going to have to be driving, and that's where the expense comes in. And obviously vacancy loss, you lose one on a single family home, it's 100% vacant. You lose one on a 10 or 12 or 20 or 100 unit property, it's 2%, 1%. You're still making money in other ones. And again, nothing new here, but just kind of giving you an idea of the difference, in the reality of it. You get chasing the tenants to collect the rents, managing yourself challenges. That's another thing that I really kind of don't miss when I was doing my single family, is chasing the people, for the money. Where when you invest in multifamily in the commercial side of the business, you have a property manager to do that, and they usually engage a attorney, and it's more of a business than it is, you're renting to your friends or whatever. Vacancy loss is actually, like 2 houses vacant out of 6, or is 33% vacancy. A 33% vacancy in multifamily is huge, depending on the number of vacancies, and that costs you a lot of money. In the downturn, obviously single-family homes drop dramatically. What we've seen from here in Michigan, let's say, is that the occupancy hasn't really been affected by COVID. In fact, the number of people who are not paying really hasn't moved the needle much. The next, I guess, to this point, the next mile marker, we want to call it, or milestone, is next month's rent, and see, because some of the stimulus package is worn off, but the people that I'm talking with and owners that have properties that I've been speaking with really haven't had a problem with that, because there's some federal and state and local assistance out there for renters, and they're already ahead of that. They're already in there, which is good, right? And requires more time and money to get you in there. Let me see here. Apologize. There it is. My mouse was not working for a minute there. Requires more time, right? And we all know this, and this is probably not new. Vacancies are a huge impact in attaining cash flow. Trying to get people, because again, if you're doing single family rentals, typically I was doing leased options or lease to own. So I was working with those people to get their credit up so they could buy the house from me, right? So I could move on to the next step. Where in a multifamily, you're just basically renting for as long as they want to stay there. And again, a lot of different things hit there. A lot of people during this time now are having to do that. Hello, somebody there? Okay, all right. So why apartments, right? Why invest in apartments? But first, we got to talk about what is an emerging market, right? What is an emerging market? Why do we look for those? Now, I didn't do this in the single family part of the business. One, because I didn't know about it, and two, I really didn't know about it. So I educated myself. Real estate market is the potential to grow and appreciate within 5 to 7 years of holding real estate. And that's the key in the multifamily, is that appreciation or forced appreciation, meaning if you can do things to the asset and the management of it, the running of it, and the actual asset itself to increase the value. Another huge difference, which I didn't have on these slides, is that single family home value or appreciation is based on your next door neighbor, or the guy across the street, or 2 doors down that has the same type of house as you. Now, in the multifamily and commercial end of the business, we can have 2 apartment buildings right across the street from each other, and they can be valued and very, very different in price, maybe hundreds or thousands of dollars, or maybe even $1 million difference based on the operating income of that property. And that's the big, huge difference, is that the income of a commercial property dictates, and the expenses dictates the value of the property. Right. So emerging markets we look for has job growth, has new companies coming in, people migrating, people population growth. Now I kid and say, oh, Michigan this, but there are cities in Michigan that is actually happening in here. There is areas of Michigan that are growing. The west side of the state, Kalamazoo and Grand Rapids area. There's a couple cities over in that end of the spectrum that do have these. So those are areas we target. So even though overall the state may be losing population, right, there's other pockets that you have to look in that is going there. Now, having new companies coming in, people moving into the area, having low construction rates and people, just more general people coming in there helps. For what reason? What reason is to bring new people into your new apartment building that you just bought, so that you can have them rent from you. If everybody's leaving the city, nobody's going to stop to rent and sign a year lease for your apartment building while they're checking out and running down to Florida, right? So emerging markets is very important. I can remember Dave Lindahl back 15 years ago. He actually wrote a book on emerging markets, and it's very powerful when you start following those trends and you start following that kind of stuff, even in a state that may not be growing. That pun for Michigan, there is pockets in Michigan that are growing, and you have to know that, and that's where we invest in. All right. So what is the ideal market for an ideal investment, right? Stable industries, right? Large businesses, service businesses, a mixture of different things. I can remember, 5-10 years ago, that all that Michigan was known for is manufacturing. Right. I mean, that was it, right? It was autos. Now that's kind of turning, right? That's kind of turning. Yes, autos are in, and that type of business and vendors are still big, but now it's a little bit more of tech and a little bit more service. That's what you need. So that's, and a good case in point is here, the city like of Orlando. Yes, it's a hot spot, but with this COVID and everything hitting, it got crushed. Why? Because 90% of its population is in the service industry. Well, Orlando shuts down and hotels shut down and Disney shuts down. Guess what? That means, you got to take a look at that and see there's more of a diverse economy, new jobs coming in, high potential for renters versus homeowners. I also look at the cost of a new home, and there's got to be barriers to entry, right? There's got to be a barrier to entry. If I'm a renter and I can't afford the single family home at, let's say, $200,000, $300,000, $400,000, it's just cheaper for me to rent. And that's what you look for as well, right? You also look for state capitals, universities. That's big in a downturn, is the universities. So we look at all that, and we look at all those different points to see if this city or this state or this county is somewhere that we want to invest in. Right. So what is the value add? What do we mean a value add? Now, value add is obviously, the properties run down, deferred maintenance. There's few and far between of those sometimes, but a lot of times you can find value add in other different things, like the residential utility bill backs, the RUB system. It's amazing how many things. One of the properties we have under contract right now, the landlord still pays the water, and that just amazes to me, because I've owned single family homes. I own my own home, and I'm like, why would somebody else pay my water? And but it's just those things you can look at, and that can, you can improve on that, and that's a value add, right? Can you go in and add playgrounds? Can you add a dog park? Can you add in, something with the Wi-Fi? So there's a lot of different things than just the actual property is run down. Obviously those are great, but there's also what else can you add to the property? You know, parks, dog parks, you know, fitness centers are big now. You know, renting out your leasing center for parties. Those are all different value adds that you can take a look at when you're watching. And again, I'm not expecting you as an investor to do that. That's what we look for when we look at these opportunities, and we put that all into our analysis to find out what is the business plan, what is the best way to hit the numbers we're looking for on this property. We also look in two different areas of apartments. Now here on the screen here is all the different classes of properties, and the two in red are ones we don't look at. Now, class A is luxury apartments with modern amenities, good location, you know, less than 10 years old, the shiny pennies, right? Typically when people buy those, they just buy them for a place to park their money. The yield is very little because it hasn't been long, right? The property's built at the top of the market, and there's just no return. It's basically really, you know, it's just a place to park money. Number B over here are Class B and also Class C is the two areas that we look for our apartments in. Okay, the tenant mix of white and blue collar workers. It's an okay location. The building's typically, you know, less than 20 years old, sometimes 30, depending on the area. And then there's where you can add in the value if it's got, you know, let's say, you know, galvanized piping, or if it doesn't have, you know, if it's got a flat roof, stuff like this. You can look at C tenant as well. Same thing there. These are what they call workforce housing project, or, you know, kind of complexes. And this is what really kind of drives the economy. So that's the two areas we look in, or class-wise and neighborhoods. And typically what we look for, and again, state by state it's different, you know, we look for annual income in the household. For a C level would probably, in Michigan here, it's around 35,000 and up. Now in Georgia, it may be lower, maybe 25,000, but again, cost of living, the same thing. You know, you got to take it state by state, but we look at that depending on where the investment is at. And obviously D here on the far right is your war zones, right? Those are places that you know, the AK-47 to go in and collect rent. Not banging anybody who does that. I'm sure a lot of people make a lot of good money in that, but that's just not our philosophy. So our philosophy is in the B and C type of area, where we can get good returns and a stable workforce. Okay, so again, why apartments? Again, historically stable. Over the past 4 decades, multifamily has returns exceeded. I'm sure you've heard in the news that apartments are doing great. Yes, they are. They're doing very well, and they do well in a downturn as well, because again, it's not somebody. Here's the biggest thing that I heard somebody say the other day is, you know what, I'm going to invest my money instead of putting it in a bank and making 0.01%. I'm going to put it into housing, right? Everybody's got to live somewhere, especially now. That's more so more important, because now guess what? Everybody's working from home, right? They got to have that place to live, so they're going to pay the money. They may upgrade a little bit in apartments because now, you know, dad's got an office or mom's got an office upstairs, where before they didn't have that, because work from home may be here for another 6, 7, 10 months. Don't know, right? So it's even more, you know, stable now. And again, housing is always a good thing, because they're always going to pay money to be in a house, right? Or some type of housing, right? And increasing demand, like we talked about here. Again, you know, over 60 million in the next 25 years, and I'll show you in a couple slides here of why that demand is going to still keep going, because of what's going on currently and what has happened in the past as well. And here it is right here. Because of new construction, right? New construction has been down for the last, I'd say, 10 to 15 years, right? 2008, new multifamily dropped 15%. Now, the demand, or I should say the new construction is still there, but the demand is still there, correct? So now we have 15%. Now in 09, it plunged again, right? From the 2008 bubble. And then 2010, it dropped another 30%. So, if you take a look at that, you're down 60%. Well, we can't backfill fast enough. And then now recently in the last, 4 or 5 months, everything stopped with the COVID coming in. And again, that put a strain on the already strained system of new construction, not only with the financing part of it, but the construction of it. Right? You may have been able to get financing, but that was pretty much stopped. But now all of a sudden, you can't get crews on your site because guess what? You're locked out, right? So you can see there's a pent up demand going forward, going all the way back to 2008. And I don't have exact numbers, and I will try to do that for the next presentation. But you can just see the pent up demand of why apartments are so in demand, because there's not enough in areas. They're so much under where it needs to be, and that's why the prices have been driven up, right? That's why your rents are going, for a 1,200 or 11 or 800 square foot apartment, they're $1,200, $1,300 a month. I mean, it's just insane, but that's what's causing it, right? And also, last thing I'd like to talk about is the tax advantage with apartments, right? The real advantage that the small investor can take advantage of, i.e. you, where if you invest in the properties that the syndicators like myself have, is the real tax advantage. You get to write off depreciation, allow annual depreciation to be written off as an expense item, resulting in an additional tax shelter. We're all talking about, and next time, they talk about Trump's tax documents and all that kind of stuff. And I've told probably a couple of people here on this call that, the average person, including me, probably wouldn't even understand his tax returns, because he's got so much carried forward depreciation and loss and this, that it would just convolute them, and your head would explode, right? But that's why he uses depreciation. He uses all those commercial and tax things that you can to push off paying taxes, right? There's no capital gains tax. Your taxes can be deferred for life if you roll over your capital gains to a like kind or in a 1031 exchange, right? That's huge. That's huge. You sell a building and you get a taxable gain of $2 million, and you know that you can roll that over and defer 40% taxes until the next time you don't want to do it, or just keep doing it until your heirs take it over. That's huge, right? Another one is the 15% tax liability on the cash flow of the cash flow you'll be receiving from an investment, right? It's at 15% instead of the capital gains tax rate, right? Your spendable cash flows are adjusted to 15% tax liability. Now, what I'm doing here is, I'm not an accountant, I'm not a broker, I'm not a lawyer. I'm using generic figures, so don't quote me and say, okay, I'm going to make 15%. But again, these are in the tax code, and getting a competent tax accountant when you invest with somebody, with like us, get with somebody and figure out your situation and how it applies to you. You may not want to do this, or you may want to do this plus something else. So I'm just saying, in general, these are the benefits and the advantages of investing in commercial or real estate. Depreciation is a non-cash deduction. It reduces your taxable income from the investment property. In contract, you're obviously, in contrast, your property taxes on your single family, your mortgage interest, and utilities, insurance, repairs doesn't require any cash outlay, right? Or it does, right? But depreciation expense can result in a positive cash flow property becoming a loss maker for tax purposes, right? So this screen here, and again, I'm not an expert on this. I'm not a tax accounting person. This is where carried forward depreciation can be offset against your income, where then you can carry it forward. You have losses for many years. And that's how people get wealthy beyond imagination. But this is just one of the caveats. And again, please consult your tax attorney, your accountant people, we're doing this, and we would supply all this needed information to them when you invest with us. So don't think that we're just going to tell you about it and then let you go. So we at least would inform you about doing that, but I'm just giving you the high level overviews here. Most investment properties go up in value each year, and on paper their value is going down due to depreciation. Okay, and that's an accounting trick. I shouldn't say a trick, but that's an accounting rule. They go up, but the depreciation eats away at the value of the property. But again, it's kind of a phantom thing. And again, I don't want to get into an accounting lesson right here on the phone, but it's a good thing to have. And also Marcus and Millichap, they remain bullish on the U.S. apartment market. And Marcus and Millichap is one of the national, largest firms that sells and brokers apartment complexes. High levels of future demand, like we talked about earlier as well. Supply more difficult and expensive to deliver, as we've seen just in the last 5 or 6 months. We had a great booming economy. Before the pandemic, we had building supplies. Those were getting so expensive, and it was, people were depending on were they going to build or just, take over existing. And now that when the pandemic hits, boom, you got something where now you got to really think about, how are you going to do this? Current rents in most markets do not justify development, and significant future pressure on rents. Is again, that's just Marcus and Millichap letting us know what's going on. Traditional investment options. Now you have other options, right? I'm not saying commercial real estate and multifamily in particular is the best thing out there, but you also got to look at what you're doing right now, right? We got the banks, right? We got savings. In fact, I opened up a savings account for my son a couple weeks ago, and she told me what the amount of savings that they give, the percentage was 0.012%. And I almost fell out of my chair laughing so hard that I couldn't believe it. And then also the CDs is paying something, I think it was 0.12%. And it was just crazy. But again, that's what's available currently. That's why I'm sharing this information with you, because there is another alternative. Okay, investing in commercial real estate. You can also do the stock market. You can also do mutual funds, potential higher, rate, but more risk, right? uh, you know all the different things you can do, you do this. So bottom line, your investments dollars are not in your control with these options, right? With real estate, you invest in it. If you need your money out, we replace your investment with another individual, or when we refinance, liquidate, we get your money back, right? When you go into stocks and bonds and CDs, there's typically you have to leave it in for 5 months or 10 months or a year or 2 years to get any kind of returns, right? But you already know that, right? So I'm just kind of letting you know there's different options for this, for your money. We also look at also doing self-directed IRAs. You can use your current IRA and turn that over to a self-directed. And again, I don't want to get too in the weeds in this call, but that's just one option for people that have a W-2 job. You can use and transfer that over, and we would help you do that. There's a couple firms we use to have that happen, and it's a seamless to you that you can invest in real estate, in ours or other people's as well. So right now we have currently, and all I can really say right now is we have currently 2 opportunities, and the reason for this Zoom call is, one, to introduce again me to you and us to you, and kind of give you an idea what's going on and the different reasons of multifamily. Uh, but SEC rules restrict me from talking any more than I'm doing right here on the screen here. We do have 2 opportunities. One is a 167 unit in Georgia, and one is a 71 unit in Missouri that we are raising money for. All I can say at this point here is the next steps would be is, if this is of interest to you, and I know I went pretty fast, but I do want to have some time for questions and answers, is if anybody's interested in investing in one of these, or further or ones coming up, please set up and give me a jingle, give me a call. Here's my information right here. That's my cell phone number, my website, my email address. And I know some of you have already reached out to me, and we'll have to get together. Because of the new SEC rules, we've got to have a substantial relationships, a subsidence relationship. I can't get into details in great detail here, but in our one-on-one call, we would walk you through the different steps we have to take to, again, just like when you're trying to, let's say when you did your financial planner, right? They didn't, see you the first day and say, okay, great, give me your money, let's go, right? You got to get comfortable. And maybe this is not an investment for you. Maybe you have questions that you want to ask that before you give us your money. Obviously, we want all the questions answered, right? Before you invest, we want you to feel comfortable. And for some people we've talked to, it hasn't been for them. Now, I can tell you right now is if you are needing this money to live on, or if you're needing this money back in the next year and a half, please don't give the money to myself or anybody else, because you're not going to get it back at that point. Okay, it's just, you're not going to get the returns you need. It's just going to be a lot more work for you to do that. So this is like your retirement funds. This is like your 401k, different stuff that you do in the stock market, different things like that. That's what this money is for. And again, I can go in more depth. Please reach out to me. Please contact me. We'll set up a Zoom call and we'll go into more detail, and I'll go over to more information as far as the couple different opportunities we have now, and the other ones that we're looking at as well. So, and just get our process so you understand. And if not, if you don't want to invest in us, that's great. At least if I gave you a little bit of education, a little bit of knowledge that you can do it in a couple of years from now, great, fantastic. So, but anyway, that's all I had. I'm going to open up the floor to questions. If anybody has any questions, any comments, I will do that right now. Let's see here. Let me stop sharing here. All right. Does anybody have any questions? Anything I said spark a question?
Yes, Pat, this is Dharmendra.
Hey, how you doing, sir?
Good, how are you?
Good.
So I did put in my question in the chat window, but I'm going to just say it here.
Okay.
So just like everything, not every dice falls right and gives you the six every time, right?
You got it.
So sometimes, more often we succeed, and that's why there's a reason to stay in the business. And maybe sometimes we don't. So for you, let's say you're investing in 30 properties like this. So if two are not giving you appreciation and the cash flow the way you expect, that's okay. But for a person like me, this is my one and only one investment that I'm looking at for the properties like this. I would like to know what are the chances of our success here. And I understand you said the earlier, the appreciation and everything you talked about, but just a little more information.
So your question, let me make sure I understand your question, is you're thinking this is your let's say your last hurrah, and that if this money, let's say X amount of money, is given in an investment such as this, you want to know what's the chances of success.
Correct.
Okay. I can tell you this, that they're greater than giving your money to some financial advisor or putting it in the stock market. I can tell you that. And we follow a process that's been the process probably for the last 20 or 30 years of doing what this is called private money or private lending. That's basically what this is. But that's a great question. But what I would do is in our one-on-ones, or if you're going to talk to somebody else, have them go over what the returns are, how they come up with those returns, what is their business plan to get those returns, right? And ask questions about those. Here's a case in point is, okay, hey, all we're going to do is raise rents by 150 bucks. Okay, great. That sounds good, and that's a good boost to the income, right? But what if that doesn't work, right? What if the rents are at market, like what we're finding out in one of our properties here? There's not that huge bump, right? So now we're looking for different value add or the business plan is shifting. So I would ask somebody there is, okay, what is the business plan to increase the value of this property, right? If it's just raise rents and that's it, okay, well, that may not be the investment that you want to do. Now, with that being said, you can ask all those questions and talk to the sponsor and stuff like that, and it still could not come in where you want it to. I haven't heard of anyone that my knowledge failing completely, because here's another thing I'll share with you is in the commercial realm, it's more of a team than it is single family. Let me back up and explain that. Single family is you buy a rental home and you go to a mortgage broker, you get it at Flagstar, and you get your bank, and boom, there you go. And then all of a sudden you get in trouble, right? You stop paying, and what does the bank do? They start sending you, they start calling you, hey, this we oh my God, what are you doing? We want our money, we want our money, we want our. Now on the commercial side, it's a lot different. Okay. First of all, the bank is still going to contact you, but the bank knows that's an asset that is performing however way below what it's supposed to be or not. They will put in their own property manager, okay, and they'll put in their own property management and take control of that property and move that to a disposition, compared to just letting it, letting it go into foreclosure. Uh, the reason I know this is because several years ago I was working with Flagstar Bank on purchasing a couple properties, doing just that, where they instill a property manager that the bank picks. The property manager's job is to raise and maintain that asset or raise it up for the bank while they're working with the borrower. So that's probably the biggest difference compared to single family homes. Why is that? Because if they put a big for sale sign on an apartment complex, your people who can buy those is a lot smaller than your single family home, in your neighborhood, right? So there's just it's a different mindset in the commercial realm. Okay, so that's the thing. But obviously, you can still lose money. Don't let me go wrong. You can still lose money, but the chances of that are happening with a team. Meaning, I'm talking your bankers, I'm talking your accountants, your CPAs, stuff like that, your lawyers that are involved in these type of deals. The chances are less than they would be with a single family. But that's a great question. And again, I would ask and see, okay, what's your business plan? What are you promising me, right? What's the pro forma? That pro forma is a projection that we're projecting 8% cash on cash return. We're doing a IRR of 12%, and that's IRR over the whole life of the project. And then each time we get together, we would go over those numbers plus or minus and find out why there are. So, and then that's a great question. Did that answer your question? I didn't mean to
Thank you.
go on.
Yes.
So, okay. And that is, you should be asking that. You should be asking another question you should be asking for everybody is, what kind of communication am I going to get from the person I'm giving the money from, right? The company. We do monthly, depending on the type of value add, how heavy a lift it is. It could be bi-weekly, it could be weekly. Because again, we want to make sure that you feel comfortable with what we're doing, the business plan and stuff like that. So, but ask those kind of questions, because those are great questions. Anybody else?
Yeah, Pat, Dan here.
Hey, Dan.
Hey, as far as any kind of distributions, are those going to be, is your typical format that it's a straight percentage cash on cash return, or depending on the property, can it possibly be a limited partnership?
Okay. Let me make sure I understand your question. There's two different. Okay. There's two questions in one. One, when let's say that everybody on this phone wants to invest in one of the properties that we have available here, you would go in as a limited partner in a typical commercial is a general partner, which is the managers of the thing that we've signed on the loan. We've put the deal together, and there's a limited partners, which are basically the investors, and that would be people such as yourself. Now, you can get yourself on the GP side by raising money, and that's a whole nother different ballpark to get on the GP. But so typically, Dan, to answer your question is, distributions are typically done on a quarterly basis, depending on the property. Now, over the last few months, a lot of syndicators have kind of delayed that because they wanted to use that as a cash reserve. But typically, it's done on a quarterly basis. And two, you would be on the LP side or the limited partner side of the investment. Did that answer your question?
Yeah, or could it be done where an investor says, you know what, I really don't want to be named as a limited partner. I don't want to be involved in that. I just want to be a private investor. This is the rate of return you're offering. I'm good with it. It's just private money loan. Is that part of the overall model you're using, or no?
Well, on the limited partner side or anything, when you're investing money in this on the limited partner side, you're not doing anything other than collecting a check. So you're not, and I apologize, maybe I didn't explain it right. All you're doing is jumping in our calls, listening, opening up your mail, getting or mail. I'm dating myself. You're going online and checking your account for the direct deposit of your funds. That's it. You're not expected or required to do anything. Okay, because that is all on the GP side. We take care of talking to the property manager. We take care of executing on the business plan. So on your side, you would have no involvement, right? So let me take an example. Let's say that that we go back to, let's say the 71 unit in Missouri, and you say, okay, I want to invest money, and let's say you want to invest $10,000 just to make it simple, right? That's it. Right? We're not expecting you to fly out there and go do, negotiate the contracts with the snow guys. We take care of all that. You're just a money person or a private money investor in that apartment building. That's it. So to answer your question, yes, you are just a private money investor. And also being on the limited partner side of the transaction, it limits your exposure if there is any type of lawsuit that would come from, let's say, a trip and fall, stuff like that. You're removed there again. So it is a very, very passive investment, probably just like your stocks and bonds, but your stock guy is probably not going to get on the phone with you every month and go over the property and how's it going, this and that, because they just don't do that. Did that answer your question?
Yep, and you picked up on my second half of it before I asked. It was the liability and how the limited partnership exposes you there and so forth. So
yeah.
Mm-hmm.
Yeah, and that's typically what a limited partner means is obviously you're limited in your exposure to everything, and also you're limited as far as what you're doing. You're not flying out like I would be flying out if the property's either here in Michigan or driving, to go do that kind of. Nothing like that. You're very limited. You're just a private money investor. You would just be looking for those deposits in your bank account. And obviously, we would encourage people that, hey, if they want to learn more, hey, come on along. We have no problem with that. We have no problem with, hey, we're going to the property this month or whatever. Join us. I mean that's the beauty of this business is you can share stuff, and if you have questions, hey, what about this? What about that? We can always jump on a Zoom call or a phone call. So that's a good question. Anybody else got any other questions? I'm sorry, it went so quickly here. Goodness.
Pat, I do have a question.
Sure.
You did mention, probably went through a little quick for me to grasp something about, if I'm a W-2 person and this is my investment now, you will help us with some sort of CPA consulting or somebody's to optimize my tax bracket. Is that what you said?
Yes, what we can do is we can point you in the direction of accountants that we know of and CPAs that we know of the deal in real estate related matters. Because you're not going to be able to go to H&R Block and sit down and say, hey, take care of this, because it is a little sophisticated in that. But yes, we will point you in the direction of people that do that, that will optimize and look at your whole thing and say, okay, you're investing in this real estate here, you make X in your W-2, what's the best use of this depreciation, what's the depreciation schedule, and that's kind of the technical side of it. But yes, we would help you that, because again, it's in our benefit to do that, because the more I can get you, let's say, back, or help you as much, guess what, you're going to say, wait a minute, I'm going to tell a friend, or you know what, maybe I'll do a couple $1,000s more, anything to do to help you with that, because there is such a breadth of stuff we can do. It benefits both parties. But yes, we would put you in contact with people that do that. We don't do that ourselves. So I hope I made that clear. I rely on a team, a whole bunch of people to do this stuff, that are skilled in doing this, and doing the, all the depreciation schedules and cost segregation. When we do those, we hire people who do, that's all they do. And then okay, how does it affect our limited partners? Okay, here it is, bing, 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 like that. That's a great question. And I've put back on the screen my contact information here. We're coming up on the top of the hour to make sure you guys and gals had that. Please do take advantage of that. Let me know. And I know, Dara, we've got a contact here, but I wanted to kind of just at least get everybody, on my network and list here, because I am seeing some deals coming up. So I am looking for some funds. Obviously, I can't do too much in the SEC realm here, but we're starting the conversation, right? I want to make sure, but that's my contact information. We'll set up a call, and I'll explain in more detail, the process, and then the different documents and stuff like that you're going to be seeing when you invest. All the PPM, which is the private placement memorandum, which explains everything. It explains all the risk as well, that anything can happen. You're going to lose everything, and 2 times this and that. But we have to do all that stuff, right? That's just all legal stuff that we have to do to make sure that you understand that this is this is risky too. But I look at this as less riskier than giving my money to a stockbroker, or I used to work at Ford many years ago, to a guy at Merrill Lynch, and I don't see him. I don't see him again, and all of a sudden, but they get their fees every month, and as my account was going down or up, but please take advantage of it. And again, if you guys have any questions, I put my information in the chat as well. Email me with any questions, concerns. But yeah, definitely, if you guys are interested, please let me set up something, and we'll go to the next step, which would be getting more in depth as far as what your goals are, and what you're looking at doing. And another thing is too, Dharma, is that you may want to say, you know what, you may say, okay, I'm going to do X, not X plus Y, right? You may just say, I'm going to test out this much, right, and see if it works to quell your questions, right? So that's a strategy you could try as well. Or you could do something like a self-directed IRA, where you again, you don't have to invest the whole retirement. You can do just the minimum. Typically, minimums are like 50,000 in most investments. Now, what I'm trying to do here is do a fund, which means gathering people such as yourself, everybody on the call here, that gets different amounts, probably like 20 to 25 minimum, and then invest that into a bigger syndication, right? So we hit the minimum, but everybody's doing a lot more in that. That's a strategy that a lot of people are employing. I'm gonna look at doing that, because like that 167 unit, that's in Georgia. That's another syndicator that I know. So that's what I'm doing is raising money for that in a group. So the minimums will be less, but so we'd put it in an LLC here and then invest into that group. Same things apply. And I didn't mean to get too technical, but that's what we're doing. So anybody else got any more questions before we let you go here? And I do thank you very much for everybody that stopped by, and I hope that I was able to answer your questions. Any other last minute questions?
Just in the realm of the recapture on the depreciation on the limited partner side, is there a recapture if the asset is liquidated or sold off?
That would be depending on how fast we accelerated and when it was sold in that acceleration.
Okay.
It's kind of a technical question. So meaning that, let's say that we did a depreciation and we said we're going to depreciate it or do a cost seg or whatever we want to do, and we're going to do it in 3 years, and we get an offer, in 2.5 years. We would have to take a look at it, and that typically the people that do those depreciation, those cost segs, run different scenarios for us, and then we would present that to the group and show that, okay, if this is what's happening, there may be a potential for recapture of 5%, 10%, stuff like that. But that's a great question. And that's property by property, because sometimes people don't accelerate depreciation. Some people just do, and it just depends. But that's a great question.
Okay, thank you.
No problem. Thank you. Thank you guys for calling in and joining me tonight. I'll let you go here a minute early, but thank you very much for joining me. Look for additional communications. I'm going to do some more different things here, and let's see if we can get some investors to rock and roll here. All righty. Well, listen, thank you very much for joining me, and you guys and gals have a great night.
Okay, you too.